If you're investing for the long term, you can make money in two major ways. One, capital appreciation, and two, dividend income. Now, you might know many Indian stocks like ITC that are considered to be the dividend darling of the Indian stock market. But do you know some of the best US stocks for passive income that also give price appreciation? Now, some investors chase only high dividend yields. It's tempting to buy a stock that offers a 20 to 30% dividend yield, but that's usually a trap. For example, Zim Integrated Shipping, a freight company in the US, had a dividend yield of over 100% in 2022, but the stock price crashed by more than 70% in 2023 as shipping rates fell. The dividend wasn't sustainable. On the other hand, there are companies like Johnson & Johnson, which have a yield of 3%, but a strong history of paying dividends for over 50 years, consistently increasing the payout while growing the business. And in general, a good dividend yield is also considered to be around 3% for a stock to be treated as a source of passive income. So we are not just chasing high yields here. We are looking for fundamentally sound companies that pay a stable and growing dividend and offer capital appreciation over the long run. In this video, we'll show you 5 US stocks that give you the best of both the worlds, and watch till the end to know a US stock that has been paying a monthly dividend for 656 consecutive months. Number 1. Johnson & Johnson. J&J is a dividend king, which means it has increased its dividend for over 50 consecutive years, and that's not easy to do. As of now, the dividend yield is about 3.3%. But what is more important is the consistency. J&J has paid uninterrupted dividends for over 60 years. Its business is well diversified across pharmaceuticals, medical devices, and consumer health. In fact, even during market downturns, J&J's revenues are fairly stable, making it a great defensive stock. The stock is a very good parallel to that of HUL in India, a stock that Indian investors prefer to have in their portfolio to keep it balanced during extreme volatility in the market. This stability allows it to generate strong cash flows, which it uses to pay dividends and fund R&D for future growth. Plus, the company has a strong balance sheet and an AAA credit rating, which gives you further confidence. If you want peace of mind with a reliable dividend player, then Johnson & Johnson is a core pick. Now coming to number 2, PepsiCo. PepsiCo is another dividend king with 50 plus years of dividend hikes. Currently, it yields about 3.1% like J&J, and the focus is on consistency and long-term growth. The company owns brands like Lay's, Gatorade, Quaker, Tropicana, and of course, Pepsi, which we all know has a huge market share globally. PepsiCo has pricing power, which means it can increase product prices to manage inflation and still retain customer loyalty. That translates into healthy earnings and cash flows. Over the last decade, the company has returned billions to shareholders through dividends and share buybacks. PepsiCo's payout ratio, the portion of profits it pays out as dividends, is in a safe range, around 60 to 70%, which means the company retains enough capital to invest in innovation and growth. And speaking of growth, PepsiCo is expanding aggressively in emerging markets like Latin America and investing in healthier product lines and sustainability initiatives to stay relevant with changing consumer preferences. Its combination of brand power, global scale, and financial strength makes PepsiCo a reliable growth stock. Now, the third stock is Broadcom. Now, let's talk about a tech dividend player. You might think tech stocks don't pay dividends, but Broadcom is different. It currently yields around 1.7%, which may seem low, but company has grown its dividend by over 30% CAGR over the last 10 years. Now, that's massive. Broadcom is a semiconductor giant with exposure to data centers, networking, broadband, and enterprise software. Its acquisition of VMware is a strategic move into infrastructure software. Now, what makes Broadcom unique is its capital efficiency. It generates huge free cash flow and returns most of it to its shareholders. In fact, it's on track to become a future dividend aristocrat. In its first quarter of fiscal year 2025, Broadcom reported a 25% year-over-year revenue increase, reaching $14.9 billion. The growth was driven by a 77% surge in AI semiconductor revenue. Now, semiconductors are being considered as the next oil for the world. Every major country needs it for smartphones, laptops, and TVs, cars, planes, military systems, and whatnot. Semiconductors are going to be essential chips that run all modern electronics. And as the world moves towards AI, Internet of Things, 5G, EVs, and automation, the demand for advanced chips is exploding. And this is why Broadcom holds the potential to become the next dividend king of the US. So if you want growth plus growing dividends in tech, Broadcom is definitely worth considering. Now coming to our fourth stock, Procter & Gamble. Now P&G is the company which has been behind brands like Gillette, Ariel, Tide, Pampers, and Head & Shoulders. Now this is a textbook defensive stock. People don't stop buying these products in a recession, which means Procter & Gamble's cash flows stay resilient. It is also another dividend king with over 65 years of dividend hikes and a current yield of 2.5%. More importantly, PNG continues to innovate and expand into emerging markets, giving it a long-term potential alongside steady dividends. It also boasts strong margins, excellent brand loyalty, and disciplined cost management. That combination has made PNG a favorite among conservative dividend investors. Now, finally coming to our fifth stock, which is going to be the last one for this video, is Realty Income Corporation. This is one of the few companies that pays dividends monthly, and it calls itself the monthly dividend company. Realty Income owns thousands of commercial real estate properties, primarily leased to essential businesses like Walgreens, 7-Eleven, FedEx, and Dollar General. It currently yields over 5.5% and has a 25-plus year track record of increasing dividends. Realty Income has a remarkable track record of 656 consecutive monthly dividends and 30 years of dividend increases, underscoring its commitment to returning value to its shareholders. For Indian investors, this translates to a reliable source of passive income in US dollars, offering a hedge against currency depreciation. But how have they been able to do so? Because it operates in essential retail and follows a very conservative financial strategy. And due to this, it manages to generate a stable rental income even during economic downturns. Realty Income's portfolio comprises of over 15,450 properties across US, Europe, which are leased to clients in various sectors including retail, industrial, and gaming. The company's triple net lease agreements ensure tenants are responsible for property taxes, insurance, and maintenance, providing Realty Income with predictable and stable cash flows. Realty Income is ideal for investors seeking regular income and REIT exposure in their dividend portfolio. Now, if you're wondering to actually invest in these US dividend stocks from India, that is exactly where Appreciate comes in. With Appreciate, you can buy stocks of high-quality US companies like PepsiCo, Broadcom, Johnson & Johnson, and others right from your phone. But that's not all. You also get access to US-listed ETFs, treasury bonds, and other securities to build a well-diversified, dollar-dominated portfolio. On Appreciate, there are zero remittance fees, no subscription charges, and thanks to fractional investing, you can start with as little as 1 rupee. Now join over 5 lakh Indian investors already on Appreciate and take your portfolio global, one smart investment at a time. Thank you so much for watching this video till the end, and subscribe to our channel for more such insightful videos.
Investment in securities market are subject to market risks. Read all the related documents carefully before investing.